My name's Mitch Flegg. I'm the Chief Executive of Serica Energy. I'm going to talk a little bit about Serica, but my main role really is to be the warm-up act for the guys from Rhum that are going to follow me. Serica is an established oil and gas company. I'm not going to go through the financials here. I'm not really going to go through financial projections, revenues, share price. I'm going to talk about what we do, because I think that's quite important that we inform the market about what we do as a company. We are an oil and gas producer. We have a portfolio of assets in the northern and central North Seas. It's a growing portfolio. We're in the middle of a transaction to buy another company. I'll come back to talk about that, a company called Tailwind. But we've built our portfolio in the last 10 years largely by buying assets from major oil and gas companies. So we've bought assets from BP, Total, companies like that, who basically have had the deep pockets to develop assets from new, have gone out and explored and have found oil and gas, have built platforms, have really made a great living out of those platforms. But once they've got towards the end of their life, they're not material for a company like BP or Total or the others that we've brought from. We are able, by being lean and nimble, to extract more value from assets that probably aren't as valuable to those larger companies. And I'm going to give you a couple of examples of that. I'm not going to go through all of these in detail. I'll give you a couple of examples. We did a deal some 8 or 9 years ago now to buy BP's interest in the Erskine field. Now, this is not a criticism of BP in any way, because I've got a lot of respect for what BP do. But when we bought this asset, we had what is in the industry called a CPR, a competent person's report, an independent report run to say, well, how much is left there? What is the oil and gas that is in the ground in that field? And the competent person said there's 3.6 million barrels of oil equivalent. So it's a mixture of oil and gas. We describe it as barrels of oil equivalent. So we were told there was 3.6 million barrels left. We did some work on that and we thought, no, there's more than that. There would be 3.6 if it was BP getting it out, because they're not particularly efficient. They're not going to have the drive. They're not going to have the focus. They're not going to sweat the detail. It might be 3.6 if it's BP, but we think we can get more out of that. In the, whatever it is, 9 years since we've been involved, we're not the operator, but we've been involved, we're a partner in this project. In those 9 years, we've produced almost 5.6. So we paid up front for 3.6, and we've produced 5.6. We have another one of these CPRs done every year so that we can see how much is left. I can't announce, we've got one that will be announced within the next couple of weeks. I can't tell you where we are, but my internal estimate is that we're going to end up with 3.3 left. So we've got almost everything that we bought, and we paid a fair price for it. We paid a price that was appropriate for 3.6. That's still left, and we've produced 5.6 million barrels of oil equivalent. Now, I don't know what average oil prices have been during that period, but average oil prices have probably been $60, $70 a barrel. And we've produced 5 million of those. So you can see that by having focus and attention to detail and a little bit of investment, it doesn't come for free, you have to spend money on these fields, we can produce more oil and gas, we can add value, and we can add value for our shareholders. We went on from that deal and we did another deal 3 or 4 years after that, where we bought another basket of assets from BP, coincidentally, BP and others. And this was a much bigger deal. So that first deal had been 3 million barrels that we bought. The second deal was something like 50 million barrels that we bought, a much, much bigger deal. I'm going to switch from talking in barrels because I'm going to talk about one of the fields we bought. We bought 3 fields in that deal, which was Bruce, Keith and Rhum. One of those fields was Rhum. It's had a challenged life. I could give you a 1-hour presentation on that, but I think I'd bore you stiff if I did that. But it's a big field. Over the last few years, Rhum has been one of the top 5 producing gas fields in the UK. We are responsible for something like 5% of the UK's gas production, to put it into perspective. So this is a reasonable sized field. And this is what happens to fields as they get older. So this is the plot from when we bought the asset in 2018 up until 2021. If you do nothing, these fields decline. It's just physics. It's like opening a bottle of pop. The gas comes out and it slows down and slows down and slows down, and you'll get less gas coming out of the reservoir. And I've got to be careful because there are people who probably know more about oil and gas in the room than I do, but I don't want to get too technical. But that's generally, you will decline, I don't know, perhaps 10, 12% on average. This field had been operated by BP for 10 years before we operated it. It's a very prolific field. It was only producing from 2 wells. BP had drilled a 3rd well, but they'd had problems with it and given up. We looked at this and we said, well, no, hang on, let's go back into that well. Let's go back in where BP gave up. Let's reopen the well that they failed to complete and see what we can do with this field. And so we went back in, and that's how the production has gone in the 2.5 years since we did that. Now, we had to invest. It cost us money, but we've actually taken a field that was already the 4th or 5th largest gas producer in the UK, and we've increased production by almost 50%. So again, just a little bit of application of focus, having a really good technical team means that we can add reserves, we can add value to existing assets, and that's what we do. Now, the last speaker talked a little bit about ESG, and it's worthwhile mentioning that we do really focus on our carbon emissions as part of this. Now, if I look at, I mean, this is going to be, and I'm not going to go into the units here, but the orange curve that you can see superimposed on this is our total CO2 emissions for the whole project. And there are a couple of fields involved in this. But you can see, I hope you can see, that generally we've been on a slightly downward trend with our CO2 emissions. There's a lot of good work that we do to reduce flaring, to have a more efficient system. And although it's difficult because you can see the numbers are up and down, year on year we've reduced our emissions. But what that means is that this extra production that we've got in the last year and a half have effectively come at no environmental cost. We managed to reduce our emissions at the same time as increasing our production. And this is our model. This is the model, is to get more out of existing assets. I'll give you a 3rd example, just moving on from that. And these are all different examples. There's lots of little things we do. This is another example where, and this is coming right up to date, and this is one of the fields, the Gannet field, that is part of the portfolio of assets that we're in the middle of buying at the moment. So we can't take all of the credit for this, but this is the company that we're buying have done this piece of work. And Gannet is a field that's been in production since 1998. It's been producing, and really you probably can't see this very well. I mean, this is a geological map of the top of the structure. The dark colours are higher, the light colours are lower. So this is a classic kind of saucer-shaped structure. And the field had 3 wells that were drilled into it, one there, and one there. And the geologists and geophysicists who studied this field felt that the original work that had been done by Shell in this case, so it's another example of a field that had been bought from a major and was now being run by a smaller, more nimble company. The geologists and geophysicists that were looking at this felt that these wells were too focused on the top of this structure, and that by drilling another well, and I hope you can see this, the white well down here, the 4th well on the structure, could actually access the reserves that were going to be held, we felt, in the bottom of this, in the southernmost part of the structure. That well was drilled at the end of last year. It came on stream only 2 or 3 weeks ago, and it's producing 10,000 barrels of oil a day. This field, prior to that, the entire field was producing 4,000 barrels a day. By adding a new well in here, at the cost of, I don't know, probably 30, 40 million pounds, something like that, all in, we've actually managed to add 10,000 barrels a day to our production. Again, using the same facilities, the same production, so no massive increase in the environmental footprint of doing this, but just adding value by the application of a good technical, a good team, a good bunch of people that know what they're doing. So why are we doing this current transaction that we're doing? Why are we buying more? It's quite simple. It's because we need more assets to try and do the same tricks that we've been doing for the last few years. We believe that if you give our technical people a bunch of assets, a bunch of oil fields, a bunch of gas fields, whatever it might be, we can add value to those assets. I talked previously about our assets. We had a large proportion of our reserves were gas. I talked about the Rhum field, which was massively important to us. We recognise in the current environment, having more diversity in our portfolio is quite important. So by buying the assets that we're buying when we buy the Tailwind company, we're doing two things. We're giving ourselves a little bit of diversity. In any business, you don't want to be a single asset company. You don't want all your eggs in one basket. We have most of our production coming from one single asset, and it was mostly gas. We now have two asset streams, and we have a better balance between oil and gas. So we think that this deal not only gives us more opportunities, but it gives us that balance and diversity. It makes us bigger. We'll be one of the top 10 producers in the UK of oil and gas. But it's not just scale for scale's sake. We've never wanted to just be bigger to say, oh, we produce this, we produce that. We want to be bigger because that gives us more opportunities to extract more value from the assets we have. So it does increase our reserves by more than 50%. It does increase our production by 60 or 70%. It does actually add value for all of our shareholders. And it does enhance our financial strength, and it brings a new investor in. We actually paid for this deal in shares, so we brought a new investor into to the organisation. Having said that we're not doing scale for scale's strength, as I said already, I think it brings us in to the top 10 of UK producers, a long way short of the big boys. But in fact, if you look at UK listed independents, it will probably make us into the third largest UK independent. So, and that is useful from a financial perspective. What does it do to our production? As I said, so this is Serica. This is the old company, if you like. This is our production through last year. You see ups and downs. So the colours are the different fields that we have. The lightest colour is the Rhum field that I talked about, which is our biggest producer. We have 3 other fields that we're producing from. We have shutdowns for maintenance in the summer period. We had a technical problem early in the year, but throughout the year we averaged something like 26,000 barrels of oil equivalent per day. So that in itself is a fairly makes us a fairly good producer. The company that we're buying was really very much in a growth mode. Had a kind of steady production first half of the year of around 10,000 barrels a day, brought on some new fields towards the end of the year. And so if you put the two companies together, you can see this growth throughout the year, such that by the end of the year, those two portfolios together were producing something like 45,000 barrels of oil equivalent per day. As I said, we've gone on from that, and in the first 3 months of this year, we brought on this one new well that has added another 10,000 to that. So, I'm not going to give you up-to-date numbers because they're not available to the market, but if you just add where we were at the end of last year to the 10,000 that's come on at the start of this year, you can see that that is a significant revenue stream that we're creating from 50,000 plus barrels per day. I talked a little bit earlier about, and we've seen a couple of plots like this today about volatility and commodity prices, and it is worthwhile reminding ourselves, particularly on the blue curve here, or the blue bars here, are gas prices on a monthly average through the last 3 years, and you see that it's not that long ago that gas prices were really on their knees. 2020 was a horrible year. We were profitable as a company even with gas prices down there. Seeing gas prices as they've been in the last couple of years is probably beyond most of our dreams, if I'm honest. I've never seen gas prices where they've been in the last 2 years, but we've never seen volatility like this. Within 2 months going from, I think it was 360 in August last year down to just over £1 in October, is extreme volatility in gas prices. We've seen less volatility, but still some volatility in oil prices. But you can, if you squint and look, through one eye, you can see that sometimes there is an anti-correlation. So we've seen the highest oil prices here when we saw some of the lowest gas prices for a while. So that again is why I'm keen that we actually we diversify away from just being a gas producer, so that we have some or more exposure to oil as well as gas. These curves only go on to the end of last year, but in the first 3 months of this year, I think gas prices have averaged something like 140. Oil prices have averaged probably something like $80 a barrel. So we are now far more secure against that volatility in commodity prices. So what's the outlook? With doing this deal, in fact, some of the colours haven't come out on that. You can't quite see. There are supposed to be some more bars up there. Well, I can see them on this screen, but I don't think you can see them on that screen, unfortunately. What we expect is going from the Serica of the last few years of averaging 26,000 barrels a day. We expect to remain comfortably above 40,000 for each of the next 3 years. If you could see I don't know if you can see them, but no, you can't. I promise you, there are other bars up here that say that this year we would expect it to be between 40 and 47. Next year it's between 41 and 48, and the following year between 42 and 49,000 BOE per day. And this is all without exploring. So we're not going out there, we're not relying on going and finding new oil and gas. This is just getting more value out of existing fields. And we can see a very, very strong future to do that. And I think we can beat those numbers significantly. One of the good things about having the bigger portfolio, about having bought the fields that we've bought from Tailwind, is that it gives us more opportunities. There are just more opportunities to go out there and drill new wells. There are more fields that we think we can improve. We think we can make technical improvements. We can debottleneck equipment. We can add value in many, many ways. And so what we call the organic growth opportunities, the opportunities that we have within our portfolio, will be greater by having a much bigger portfolio. We also think that it gives us the firepower for inorganic growth, to go out and continue to do more M&A deals, to go and be a consolidator within the industry, to go and buy more assets from more companies. Now, whether that actually happens in the UK or whether we do that overseas is up for grabs. I mean, clearly, and I'm not going to go into tax situation or tax or fiscal regimes this evening, but the industry has been hit very hard by increases in what they're calling windfall taxes, but the energy profits levy. We've been hit very hard by that. We're still very profitable. We will deploy that profit where we see fit, and I think it is more likely to be overseas than we previously would ever have considered. But the bottom line is, with the level of income that we have from the level of production we have, we are in a very, very good position. We're net cash. We don't have debt. We're net cash. We will not, we will be growing our balance sheet and able to deploy that where we see fit. And of course, all that leads to enhanced shareholder returns, which I guess I have to mention in this audience. So that was all I was going to say. I've beaten my time by 2 minutes, but for me, the important reason to be here is the Q&A part, and really that's why I'm here. So happy to take questions now. Thank you.
Thank you, Mitch. This lady here down the front would like to ask a question.
Yeah, hold on. Oh, sorry. Yeah. Just hi. Just a couple of questions. Can I just understand then? What you're doing is you've purchased fields from big companies and used whatever techniques you have to drill out existing gas and oil. Is that what you've done?
Yeah, I mean,
I just wanted to make,
basically, and I keep
That's
on coming.
not my main question.
I keep on coming back to BP because we've bought a few things from BP. BP have some fantastic technical skills. They have very deep pockets, so they like to deploy their technical skills on billion-dollar projects. So for them, for something to be material, it's got to be let's say a billion-dollar project. We're not in that league. Okay. I'm not looking for those projects. Yeah. I'm prepared to deploy our resources on at a lower threshold. We can do it cheaper. We can make good money.
Yeah. So I've got two other kind of questions. The second question is who is buying this gas and oil? We know who buys from BT and things like that. And then the third is, what's the long-term future as we are trying to move away from gas and oil into more green type energies in terms of a longer term?
So our gas goes directly into the national grid. I mean, I probably did say it, but not in detail. We're solely focused on the UK North Sea. So all of our gas goes directly into the UK grid. Some of it goes directly into domestic supplies. Some of it goes into industry. Some of it goes into power generation.
Like
So
what? When you say disperse, you mean to the UK, like the smaller companies?
So it will go. Some goes directly into UK direct gas users. So industrial units that are using gas.
Okay.
Some goes into gas cookers and heating, and some goes into electricity. We don't decide where it goes. We sell to the national grid, and the national grid then diverts it wherever it needs to go. The second part of your question was, the future, and I've been giving a lot of presentations on this recently, but I haven't included these slides here today. I think the interesting thing is, and I know the numbers quite well. If you I'll just look at electricity generation for the moment, because this is where people say, right, we're going to actually go, we're going to go green on electricity generation. And I'm sure we are. I mean, I'm sure we'll get there, but the technology just doesn't exist at the moment to go totally green on electricity generation. The issue is that, the UK is not great for solar. Let's face it, solar isn't really ever going to work here. The UK is great for wind. We have brilliant wind capacity, but we all see that the wind doesn't blow every day. If the wind did blow every day, wind power would be the solution. But at the moment, we still have days when there's no wind. We have a base load of nuclear in this country. Yeah. Nuclear provides, I don't know the exact number of nuclear, probably 10-15% of our electricity. The majority of the rest comes from wind or gas. And gas is basically now the swing producer. When the wind doesn't blow, we use gas to create electricity. Something on average throughout the year, that means that more than 40% of our electricity is produced from gas. On windless days, that's up to 70%. So we still need gas. At the moment, we are, as a country, the UK is a net importer of gas. So we, even though gas isn't producing all of our electricity, we can only produce 45% of what we need in this country. So for a UK gas producer, there is a really, really strong future. Now, ultimately, I don't know when, but 20 years down the line, we'll have technology that may be able to replace some of the need for some of that gas. I think, power storage is a problem. I think battery technology isn't really there yet, but it may help at some stage. Hydrogen, well, there's a role for gas to play, but hydrogen could have a role in the future. So there's a very, very strong industrial logic for what we do at the moment, and there's, I think, a more important political logic that we have security of supply. We're importing more gas than we can produce, so I think nimble producers like us have got a very, very strong future.
Okay, great. Thank you very much. Gentleman over there.
What's your attitude towards hedging? How much of your production is hedged?
If you go back to the plot I showed of the volatility, hedging is we always see hedging as a downside protection. So the reason I mentioned we were profitable in 2020 when gas prices were very low was because we have a prudent hedging policy and we hedge to protect our downside. We have never tried to hedge to capture upside because, if there were people telling me a couple of years ago, oh, you should hedge everything you've got at 100 pence a therm because you're never going to see these times again. Just after that, gas went to 600 pence a therm, so we were quite happy we didn't hedge. So we hedge as a downside protection with a modest amount, such that if there is a crash in prices, we are protected, and that's the short answer to quite a difficult question.
Thanks, Mitch. This gentleman here.
One more. Once these fields and all wells are exhausted, what are your decommissioning costs and future costs?
So I didn't go into that in detail. I mean, where we've bought these assets from the majors, and similar with Tailwind, one of the parts of their model was very similar from us, and they bought their assets from Shell and ExxonMobil. And in every field case we have, we've left the vast majority of the decommissioning costs with the vendor. So the guys that sold the fields to us keep the decommissioning costs. Now, there's a kind of protocol building up in the industry where, we've taken a small amount of the decommissioning cost because I think someone used the phrase earlier, it's skin in the game. And so, the seller wants us to be responsible and to have some responsibility ultimately. But, in general terms, and please don't quote me on this, I think our decommissioning costs are around £1, just over £1 a barrel, which across the industry is very, very low. So we've left, the vast majority with the sellers.